Good afternoon, everybody. Thank you for joining us today. As everybody filters in, we'll take a moment or two just to do some introductions to welcome everybody. Hopefully, you've got a nice lunch and we've got a lot to go through today. So, very excited to have Kristen Chiera as part of our partners at RBC Global Asset Management today to take us through all things markets, investments, and any of your questions as well. So, if you're not familiar with the Zoom or the webinar function, there is a chat down below where you can pose your questions, and there's also a Q&A. We do want this to be as interactive as we can, so if you do have a question, please use that function, and after the presentation, we'll get through it and we will share as many questions as we can. So we'll just take a moment or two to get ready here, and I see people are starting to fizzle in. So thank you very much for joining us today. Today is Friday, October 3rd. Beautiful sunny day here. Let's hope that trend continues. So this is our team, myself, Eric, and we have Per here on the call, and Jeff as well on the advisory side, and then our wonderful support team, Leah, who's helped put this together, Joan and Kashvi as well. So if you're not familiar with our faces, though I'm sure most of you are, that's what we look like. Somewhat younger, but still quite youthful. So let's keep that trend going. Very excited to have Christian here today as part of the products group at RBC Global Asset Management. We work closely with Joseph Blaine, Christian, and the entire GAM team, and they always bring about a wealth of insights and are very well respected and well educated in this realm. So great to have you today, Christian, and we are very excited to be sharing this today with you and with everybody on the call. So just
I
a
have to say,
teaser.
Christian, I'll go back. That's a really good picture. That picture is like you look like you should be in like a British crime drama, solving murders. That the like very. It's a good picture.
Yeah, it's a
Everybody
blue
should
steel look.
admire that. Yeah, it's blue
Changed my
steel.
hair
That's
since
right.
then.
Awesome. Well done. Yeah. Well, there you go. Should be a model. Your wrong career.
Oh, gosh, too kind. Well, thank you, and thanks for having me. It's a pleasure to be here. I'll pull up some slides here. There's a lot to discuss. In my role, I present, I write market update pieces and build charts, talking about what's going on in the stock market. And it's been a really interesting year. Like I've titled this, it's the best of times, it's the worst of times, because if you just looked at the headlines, they've been pretty decidedly negative. It's been a very uncertain environment in 2025 for a whole host of reasons we'll discuss. But if you look at the stock market performance, it's been a pretty fantastic year. It's actually been one of the best so far. So it's interesting trying to square up what's been some pretty negative headlines with what's been really excellent market performance, and it leaves us feeling continued uncertainty about where we might go. So I'll try and square some of that up and hopefully make you feel a little bit more confident about where we've been and where we might be going. I like to start off with this chart. This kind of sets the stage of where the stock market has been over the long term. This blue line is the performance of Canadian stocks, and there's a couple of things. So one, the performance over time from the Canadian stock market has been excellent. Its average per year has been 8.4%. That's more than you can get from low risk investments like a savings account or Canada bond. But the trade-off of that awesome 8.4% return is it doesn't come evenly year after year. Everyone wants the yellow line, that smooth experience, but the reality is you get the blue line. You get years like this one where you earn 20% from stocks, years like 2022 where you lose money from the stock market. And even though the average is 8, it comes with 20, then -2, then 4, then 15, and it almost never is 8 in a single year. And I can illustrate that with this table here. So over the last 10, 20, and 30 years, the average return from Canadian stocks has been between 8.1 and 8.7. Very consistent. And if you ask me, Christian, what's the stock market going to average over the next decade? I'd tell you it's probably going to be between 8 and 9%. And I'm pretty confident it'll be somewhere near that. But again, that trade-off over the last 30 years, if you look at every calendar year, 2024, 2023, 2022, only one of those years has been within 1% of the average. So while the stock market is extremely, extremely reliable over the long term at delivering excellent results, the trade-off is the short term is quite uncertain. And this year's been just another example of that. So, the stock market, it goes up and down. This is an illustration of periods where it's gone on what we call bull markets, when it's gone up for an extended period, and in orange, what we call bear markets, where it's gone down. And a couple of things, I point to here. First of all, bear markets, these market downturns are a normal part of investing. It's almost impossible to go through a financial plan where you don't encounter a market downturn. And in fact, the last 5 years, we've had two pretty significant market downturns through COVID and the inflation shock in 2022. However, while bear markets are not sweet, they are short. And you can see, these orange periods, primarily have been less than 1 year in duration, almost always less than 2 years. So, as you think about your financial plan and investing in the stock market, uh, you should be prepared, for a market downturn at some point, at least one. But what's most important is that you stay invested because if you sell during these times, you can destroy a lot of value from the blue periods. And you might be saying, Christian, I know this, buy low, sell high. It's literally the only thing a lot of people know about investing. But I promise you, it's not what people do. In fact, they do the exact opposite. And at RBC Global Asset Management, I have the privilege, I get to see both stock market performance and investor flows in and out of stocks. And when you overlay them on top of each other, you see that what most people do is not buy low, sell high. They buy high, sell low. And every time the market bottoms, there's this period of selling that comes afterwards. And you can look at the global financial crisis. There's years of selling throughout the whole recovery when investors would have been better served buying. You look at the oil crisis, you look at COVID, you look at 2022, it's the same pattern. So, as we're going to talk about a lot of different themes going on in the Canadian US stock market, and some are very positive, some are more uncertain. But if I can leave you with one thing in the presentation today, it's the importance of discipline in investing. It's why you work with advisors like WWH, and ultimately, this is the secret to delivering strong results in your financial plan. It's not doing the wrong thing when the market sells off. Okay, so let's talk about some of the themes in markets. So we'll start with the US, the ever-evolving US government policy. Not a lot of government policy being enacted at the moment with the government shut down, but there has been a lot of developments over the course of 2025. The US government is in a difficult predicament because for the first time in what's really been several decades, they're struggling with a mountain of debt. And a lot of this debt was taken out during COVID when the government needed to provide stimulus to help businesses and consumers that were struggling with shutdowns. But now you look at the level of debt and, more importantly, the level of interest payments that the US government's paying on this debt, and it's just about as high as it's ever been. So, this is a bit of a constraint if you're someone like Donald Trump who wants to spend on economic growth and prosperity of Americans. If you are Donald Trump and you've got the big bill that he's put through, the one big beautiful bill, you have to pay for this somehow, and debt is not a good option because interest payments are already very, very high. So what do? Well, you could introduce a new tax for a Republican president. That would probably be political suicide and clearly is not the direction that he wants to go. Another option is to cut spending, and Donald Trump has tried a number of methods to do this. It started with the whole Doge thing with Elon Musk in the White House with the chainsaw talking about cutting government waste. That didn't really work so well, so then it pivoted to cuts to programs like Medicaid, the food stamps program, and environmental regulation. And he's perhaps saved some money there, but not as much as he spent in the bill. So you kind of end up with this last piece, which is tariffs. And this appears to be Donald Trump's desired method of bringing in money to pay for the growth that he wants to spend. And tariffs act a lot like a tax. It makes things more expensive that Americans want to buy. But the difference is politically, you can position a tariff as rectifying an injustice that's been inflicted on the U.S., getting even with trading partners. It's just a better way, in at least the Republicans' view, to position what is ultimately going to be a headwind for U.S. consumers. And we've seen tariffs kind of fast and furious this year. This is a look at the weighted average tariff rate in the U.S. going back to the late 1700s. And what you can see in particular for the last 50 odd years is the U.S. has become more and more open to trade. They have found that it's been positive for Americans if they can buy stuff more cheaply that's produced abroad. It's better for businesses if the inputs into their processes are bought at a lower price. And now that's all reversed. We're at where that dotted line is with all of Trump's tariffs he's put in place, which really brings the U.S. back to a weighted average tariff rate that mimics where they were during the Great Depression in the 30s. So obviously, some pretty serious implications from this. That we've spent a lot of time, every business that we cover, looking at how this might impact their profitability or their cash flow. And the good news is for the U.S. economy, while this is a pretty massive increase in the tariff rate, first of all, most things that people spend on are not goods but services. You think of where your income goes to. 2/3 on average will go to things like insurance, healthcare in the U.S., mortgage payments, vacations, restaurants, things that are not physical goods. Only about 1/3 of what we spend on is actually goods. And then of that third, the majority of that, in Americans' case, is on goods that are produced in America, so not tariff stuff. So again, that third of spending is diluted again by 1/3, given that most things are not imported. So when you actually break down the tariff rate into how much of spending is going to be impacted, it's maybe at least a lower number than you might think on the surface. But nonetheless, the US has struggled with sticky inflation. Inflation was extremely high, as you can see from the yellow line here, core PCE. That's just inflation without energy and food, basically. If you look at inflation, back in 2022, it was out of control, frankly, and you would have felt that here in Canada too. Everything was expensive as there's all these supply chain constraints from COVID and all the spending because of all the stimulus. And now you look at inflation, it's come down significantly, but it's still above that 2% target. So for the US, they're still not out of the woods on inflation, and tariffs have made things more expensive, which has contributed to this. But at the same time, the other economic headwind has been the economy. And in the US, unemployment's not as high as it is here in Canada, but it has been rising pretty steadily since 2022. Part of that is the uncertainty around government policy and around tariffs. So, as you think about investing in US equities, these are the two things that you're thinking a lot about. Is the US consumer and US businesses going to feel, the economic effects of elevated inflation and tariffs, and that ultimately impact their hiring and ultimately their profitability. So what the U.S. central bank has been doing is starting to cut interest rates. In Canada, we've had a lot of interest rate cuts, and I'll talk about Canada a bit later. But in the U.S., they're really towards the beginning of their interest rate cutting cycle. There's two more. They just cut interest rates. They're expected to cut interest rates 2 more times this fall, and then 2 more times in the first half of 2026. So this is a look at the U.S. key interest rate over time, and you can see the massive ramp up in 2022 to combat inflation. Raising interest rates slows down the economy, slows down spending and borrowing, and brings down inflation. But now the central bank they're still fighting inflation, but they've determined that the economy is the more pressing issue, and as such, are lowering interest rates. Now, on the positive side, so on the negative side, tariffs, economic concerns are weighing on businesses. On the positive side, Trump did get his spending bill through, and it did have a lot of positive pieces for American businesses. And and the highest end, the highest earning American consumer as well. For businesses, the biggest piece was this change to basically the taxation of businesses that spend in the US. So basically, if you spend a lot of money in the US, you get a tax break through basically this balance sheet trick on how you account for depreciation. So this means a lot of businesses, a lot of big businesses that are spending, like utilities, like car manufacturers, and maybe most of all, big tech companies are getting a pretty big tax break from Trump's bill, which has a lot of implications for the U.S. economy. These, I'll talk about AI in a minute, but these big tech companies, Microsoft, Google, Amazon, Meta, Meta owns Facebook and Instagram. These four companies are spending an insane amount of money on artificial intelligence capacity. Basically, they're building big data centers filled with computers so that businesses can run their AI application through these data centers. And this is a look in blue at what these four companies have spent and are expected to spend in future years. And then the yellow is the increase that they can spend thanks to Trump's tax bill. And we're talking about, next year, these four companies spending as much money as the entire Canadian federal budget just on data centers. It's massive, massive spending, and it's not just these tech companies that are impacted, but this money is going to companies like Nvidia, who makes computer chips. It's going to companies that make memory, that make storage. It's going to construction companies. It's going to power companies. It's going to cooling. There's all parts of the economy are getting driven by this massive, massive spend that's only become bigger. So this is really carrying the S&P 500, the U.S. market. And there's so many companies that are impacted. I think one of the ones that we're going to hear a lot about, we've already been starting to hear about it, but I think it's only going to grow in importance is power. These data centers, just one of these data centers requires as much power as the entire city of Ottawa. It's it's just massive how much power these data centers demand, and there isn't enough capacity. And it's extremely complicated in the U.S. because there's also the transmission between states, and power is a state issue, and will they all agree on building capacity at the same rate? Ultimately, there's a lot of considerations for a lot of different companies, but the big power needs of these data centers, I think, is likely going to be a limiting factor as tech companies are happy to spend the money now, but trying to find nuclear or natural gas or renewable power for these things is going to take some time. So why are they building these data centers? Why is AI such a big deal? Well, I'll talk about some specific examples. Basically, every company that we talk to is telling us that AI is their biggest priority. And AI is not necessarily new. You can trace its roots back to 1950 when Alan Turing published his paper that turned into the Turing test. Basically, he had this hypothesis that we'd come to an age where we couldn't tell if we were talking to a computer or a human based on its responses. And he was clearly ahead of his time, but that's really where we are now. ChatGPT passes the most rigorous Turing test. It's very, very tough to even realize you're talking to an AI. In the 60s, we had the first autonomous vehicle powered by artificial intelligence. It wasn't super impressive. It looks like a shopping cart on wheels, but it technically could navigate a classroom full of chairs autonomously. We had a bit of a AI dry spell, but we did have the association of the advancement of artificial intelligence in the 70s. At the end of the 90s, AI was better at chess than the best chess player in the entire world. And then we started to have quite quick development. We had robot vacuums in the early 2000s, which today are quite good. Back then, mostly threw themselves down the stairs and ran into walls. 2011, AI could beat Jeopardy contestants at their own game. 2018, Alibaba had an AI that passed a really rigorous reading and comprehension test. But the big moment for AI was 2022, and that's when OpenAI released ChatGPT. It's broken all sorts of records for downloads, utilization, and it can do things that really weren't thought of as possible from AI. It can create poetry, artwork, video, and basically speak indistinguishably from a human. And why is this important? Well, there's a lot of things that previously were constraints that are now reality. Just a few years ago, if you fed this picture into a computer, it would really only be able to identify it if it had been trained on this exact picture with the exact pixels in the exact same place. But you and I, we know what this is without having seen this picture before because we've seen other pizzas in our life, and we can conclude that this is also probably a pizza. We're at the time now where ChatGPT hasn't seen this exact image, but it's seen other pizza images, and it's intelligent enough to be able to conclude that this is probably also a pizza because the colors and the shapes match other pizzas that it's seen. And that it maybe sounds like you know, nuance or like not a big change, but it really is, because if a computer can now think about things that it hasn't explicitly been trained on, or identify things it hasn't explicitly seen before, that can make computers a lot more intelligent than they currently were. It opens up the door for cars to drive intelligently through the road. Google has 5 cities now where they're operating fully autonomous taxis. You may have taken one yourself. They're a bit spooky. They don't have a driver, so you can call one on your Uber app and it'll show up, and you get in, and it's just a bit jarring, but it does technically, it drives like a human. In fact, better than a human. Its track record is many, many times better than a human taxi driver. And really, it's only possible. I mean, these cars have LiDAR, they have radar, they're extremely sophisticated, but all around the car are cameras powered by Google's AI. And Google's AI can recognize things that it hasn't explicitly been trained on before. It can see bikes that it hasn't seen before. It can see, maybe a new road sign that it's not familiar with, a car it's never seen. And we've been in part helping to train this AI through things like CAPTCHA tests. Google bought CAPTCHA back in 2009, and they started putting Google Street View images in it. And now every time we do one of these tests where we you identify a motorcycle and prove that we're a human buying Taylor Swift tickets, this helps train Google's AI to help their taxi drive more intelligently. So here's an example. It's a kind of a fun one, but both Google and Tesla, because of the advancements in AI, are at a very rapid pace looking to continue deploying uh, autonomous vehicles on the road. But it's not just tech companies. We had the management team of John Deere in our office, and John Deere obviously is not a classic tech company. They're a tractor company, but they're doing some really cool things with AI. They have this See and Spray technology that it basically uses AI to identify weeds as the tractor is going up and down the field. And because this allows farmers to no longer just blanket spray herbicide on the field, they save a ton of money. And it's shown to be really effective as well. So this for John Deere is a great business because they can charge $25,000 for it. On average, farmers are saying that they get that $25,000 back in the first year just on chemical savings. And this is only possible because this AI can identify weeds, again, that it's never seen before. It's connected to the internet in remote locations through Starlink. So it's again, a really thoughtful implementation of AI from a company that's definitely not a tech company. They also have a self-driving tractor kit where they say that farmers can be sipping their coffee and their tractor will do all the work, but that one is not yet proven, but also equally exciting. And then there's people always ask, okay, so there's so much spending on AI, but are we actually seeing like tangible results? And there are a lot of cases where we are. The biggest example is advertising. Advertising has changed dramatically over the last few years. No longer are we just spraying ads, hoping to catch a customer that is applicable to the product we're selling. If you advertise on Instagram, you can ask for males age 18 to 23 in big cities that own dogs that are fans of the Toronto Maple Leafs, and you can deliver ads specifically to that person. And that has meant that advertising is a lot more effective. Instagram, Facebook, Google, they can charge a lot more for advertising. And the revenue that these companies are generating off ads is incredible. And a lot of that's thanks to AI and being able to intelligently, understand our preferences and what we like and deliver that to advertisers. And then the last example, and this is one where many, many businesses can benefit, customer service, basic customer service, basic troubleshooting. Currently humans are doing a lot of this. A lot of it's outsourced, but it's ultimately humans that are helping you navigate your online banking, for instance, or troubleshoot issues with your laptop. An AI can do this more efficiently, much more cheaply, and we're not far from the point where you call a company looking for tech support, and you don't even know whether you're talking to a human or an AI. So this is coming quickly, and many many companies, including RBC, have talked about this as a serious measure for cost savings. So how has this all been possible? Well, a big reason for it's been a massive development of compute power. This is an NVIDIA chip. This is now the old NVIDIA chip, but it's the one that was really groundbreaking, that had 80 million transistors on it. Their new chip has 20 million transistors on it. And basically, these chips are the Ferrari of computer chips. Every data center is stuffed full of these. And NVIDIA is able to make them for $1,000 and sell them for 30, 40 grand. And ChatGPT is hundreds of thousands of these. So NVIDIA has been the big winner so far. They're the company that makes the chip that everyone wants, and they're selling them faster than they can buy them, or faster than they can make them. And you look at the stock price performance, it's been pretty incredible. It's dwarfed even that of the US stock market, which has had two of the best years on record. So thinking about winners and losers from AI is where we're spending a lot of time. And this is really what's carrying the US stock market at the moment. There's the end users of AI, like the advertisers, like John Deere. There's the data centers, they're leveraging compute power from these data centers. They typically aren't stuffing their own office building full of these chips. Then there's all the infrastructure that goes in. There's the manufacturing of those parts. There's the complex machinery to make those parts. And then these data centers, they require networking, power, cooling. So tons and tons of companies involved. And our investment analysts spend the majority, a lot of their time thinking about who the winners and losers could be, what's priced into stocks, and where the best opportunities are. Okay, so switching to Canada. In Canada, AI is a lesser part of the story. We do have some interesting potential optionality. There could be data centers coming to Alberta. They tell us that there are going to be. There's power, there's cooling, there's some electronics, but there's bigger different themes impacting the Canadian market. If we focus on the economy first, so our central bank is called the Bank of Canada. Obviously not a bank like RBC, the Bank of Canada. You can't store your money at. They are in charge of basically two things. One, keep inflation under control, and if inflation is under control, two, look after the economy. Priority number one was a bit of a failure in 2022 because inflation ran out of control. Again, coming out of COVID, there was tons of money in people's pockets, and we weren't able to get stuff on shelves as fast as people wanted it, and it drove prices higher. And we got inflation that was nearly 8% in Canada year over year. Everyone on the call would have felt this. It's when you go to the grocery store and end up spending $150 and you expected to spend 100. So what did the Bank of Canada do? They raised interest rates very quickly. This is the same chart from earlier with the US in blue. I've added the Canadian key interest rate in yellow. And you can see, same as the US, both central banks brought interest rates up very, very quickly from near zero to counter inflation. Now, while the US is struggling a bit with inflation, in Canada, inflation is looking a lot better. It's right around its 2% target. There is still concern that tariffs will impact Canadian firms at a greater rate, especially if we don't get this trade deal as favorable terms as the current trade deal is at. But for now, we can say inflation's running at about 2%, about a normal clip. So the Bank of Canada has kind of shifted gears and is no longer focused on inflation. The big concerns for the Bank of Canada now are the economy. And Canada is the #1 trading partner of the US, but so far we've been, as you can see from the chart here, the 6th most impacted from tariffs. And the reason for this is that trade deal we have in place, USMCA or CUSMA or whatever you want to call it. It's basically shielded 90% plus of exports from being tariffed. The concern for the Bank of Canada, the concern from Canadian investors is that that could change. We could have a new trade deal that's much less friendly, and Canadian companies could be much more impacted than they currently are. It really depends on what the U.S. asks for. Some of the things that Donald Trump has expressed that he does not like about Canada, Mark Carney has delivered or promised. He's promised to increase border security and military spending. He removed the digital services tax. Likely they'll need some tougher labor standards. They'll probably ask us to limit our Chinese imports. Those are things that we think are quite deliverable. But if Trump asks for water access or to open our dairy sector or to reduce our sales tax, there's a lot of things that are very, very tough to give in a negotiation. So the trade deal uncertainty is an overhang. Hopefully we get some clarity on this around the time of Mark Carney's budget, but we think likely it's going to be a quite difficult, drawn out negotiation. And in the meantime, the uncertainty of tariffs and the future economic growth has been weighing on businesses. To use a technical term, the last 2 months of employment in Canada has been terrible. It's other than really a surprise jobs report in June, employment this year in Canada has been lackluster to poor, as businesses are not hiring when they don't know what the future of tariffs and the economy looks like, and consumers are also facing some headwinds as well. So it's a difficult environment. The uncertainty in Canada is very much weighing. So the Bank of Canada has already stepped in and cut interest rates quite a bit. We're at about half of where we were at the peak in 2022 or 2023. The expectation is there'll be one more rate cut between now and January in Canada, but the market's kind of expecting that'll be it. So obviously it's going to be data dependent, depending on inflation, depending on the economy, but we'll see. Really, I think the hands now are with Mark Carney, and if we get some corporate tax friendly provisions in the budget, we get a favorable trade deal, we could be 12 months from now talking about things being really good for Canadian businesses, but the uncertainty is definitely lingering. And this is also weighed on the Canadian dollar. This is the CAD USD exchange rate, going back to the 70s. I've highlighted in red periods where the Canadian dollar has been really strong. There was a glorious time post-financial crisis where you could go down to Buffalo and go on a shopping spree and feel incredibly rich. Lots of things were going well at that time. Our interest rates were higher than the US. Commodities were doing really well. We're a big commodity producer. And our banking system did way better during the financial crisis. But then there's other periods where the Canadian dollar's been really weak, and usually that's when commodities are weak, interest rates are lower than the US, like they are now, and the US has got some kind of innovation that we're not participating in. Today at 73 cents, the Canadian dollar is pretty depressed, and we think that some of the headwinds facing the Canadian dollar could abate over time. The oil price is very weak. That's weighing on the dollar. It's unusual for it to be this weak for a prolonged period. Interest rates, that gap between the US and Canadian interest rate is expected to shrink, and that should also be positive for the dollar. So it's tough to have too much conviction in the short term, as currencies are almost impossible to predict in the short term. Over the medium to long run, we think closer to that 80-cent 81-cent average is likely where we'll move towards. And then, finish on the Canadian housing market. Canada's unique. In Canada, the majority of a Canadian's wealth is in housing. It's a big component of GDP, 10 to 15%, depending on what you include. And ultimately, it's a big driver of what Canadian spending patterns. Like people, well, it sounds a bit silly, but they'll go out and buy things at Canadian Tire and go out to restaurants if they're paying less for their home or feeling wealthy because their home price is appreciated. So it's, as we think about the Canadian economy, like the business side is a big portion of it, but the consumer side is also important, and the housing market's part of that story. In Canada, so this is a busy chart, but the black line is the performance of the Canadian housing market going back to 2005. And there's a couple of things I'll say here. So first of all, the Canadian housing market has been an unbelievable performer. 5.2% per year may not seem like a lot, but in housing terms, it is. 3% is more normal. And if you look at different regions in Canada, which are all these colored lines, in Toronto and BC and Vancouver in particular, the price growth has been even greater than that. So it's been a really strong 20 years, but as you can probably tell, the last few prices have been down. And in fact, we're still down quite a bit from the peak in the COVID era. So we've gone from this incredible feeling of wealth and incredible wealth building for Canadians to what's been a bit of a drag. Now, as you think about, a fair long-term price estimate, so I mentioned 3%. In the U.S., wage growth over the last 20 years has been 3.5%. Home prices have grown in tandem. So for Americans, home prices have not become less affordable because wealth has grown at basically the same rate. In Canada, wage growth has grown by 3.3% per year, but home prices, even with the moderation over the last couple of years, have grown by 5.2. So, there's a disconnect there. That's affordability worsening. And Canadians have made this possible by taking out more debt. As the debt service ratio, this is how much Canadians and Americans divert of their income to interest payments. However, this isn't something that's sustainable forever, or else you end up taking on too much leverage. So, this is why I say 5.2 has been, quite unusually strong home price performance, and that 3% number is maybe a better piece to anchor on. The last, 5 years now has been a bit of a crazy ride. We had the massive rally in the COVID-19 period where people had stimulus, they couldn't travel, they were buying cottages, they were working from home, so buying nicer homes, and that just fueled a rally that was 10 times the pace of normal home price growth. And then ever since, as rates started rising and affordability worsened, home prices have been in decline. And I have in the subtitle here 2 years, but it's actually been 3 years now of prices steadily declining, especially in neighborhoods that are priciest, most expensive. Why is this happening? Well, a big reason for it is the fact that Canadians went 20 years of renewing mortgages at lower and lower rates. Basically, your mortgage comes up for renewal, your house is worth more, and you're renewing at a lower interest rate. So you've got this feeling of wealth. And what do? You buy a bigger, nicer house or a second house. Now we're in kind of year 3 of this headwind. You go to renew your mortgage and you're rolling off a really nice rate and rolling on a quite difficult one. And next year is even tougher because the average rate of mortgages expiring is 2.1. And right now the bond market is forecasting that the mortgage rate next year will be about 4.7. So this is a big increase. This is not going out to buy a nicer house. This is wondering like what you're going to cut back in spending to make this work. So that's a pretty big headwind for the housing market. You don't have people upgrading their homes. You have them thinking about affording their current one. And at the same time, new home buyers are still very stretched, despite the fact that the housing market has been weak. There's tons of numbers here, but let me just walk you through the Toronto column. In Toronto, the average home price is 1.2 million. at the current advertised mortgage rate, 4.7, if you put 20% down and borrow the rest, your monthly mortgage payment would be 5,400. And the average after-tax income in Toronto is 85,000. So if you wanted the average home and you had the average income, you'd have to put towards 76% of your income towards your mortgage payment. And when you consider the rule of thumb is to spend a third of your income towards housing, that's quite a reach. And obviously Vancouver is just crazy. Like trying to afford a home in Vancouver is quite difficult. So this is the reason new home buyers haven't been rushing to prop up the housing market. There's some challenges there too. And then lastly, I guess it's just like the bad news portion of the presentation, but condos are also going through a difficult period. Last year, condo sales hit a 28-year low in the GTA. The big reason for this is there are tons and tons of condo completions right now. Condos take like 4 or 5 years to build, and during COVID, there was tons of demand and low interest rates. So all these projects began, and now they're all finishing. 2025 was a record year or 2024 was a record year for completions. 2025 is going to surpass that. 2026 is going to be, there's going to be even more supply hitting the market. So tons and tons of condos, starting occupancy, basically coming to market, and that's weighing on prices. Now, the good news, nobody is building a new condo now. In fact, pre-sales are very difficult. A couple weeks ago, I saw a sign on the highway advertising nearly 50% pre-sold. Well, 50% is not great. Like typically you need 70% pre-sales to start construction. And right now, the average amount of pre-sales that builders are getting is sub 50. So not a lot of new supply coming to market. So very likely any weakness in the condo market that persists between this year and the next should abate in the years following. But I'll end on this. One of the questions I often get in these kinds of presentations is, what do you recommend from an investment standpoint? Should I go to housing? Should I use traditional investments like stocks and bonds? And I'm a stock guy, so I have to point out that stocks are winning. But the real answer is that there's many differences between these as investments. Differences in taxation and fees. It takes a long time to buy or sell a home. You can buy or sell a stock intraday if you want to. Canadians also borrow a lot of money to buy homes, which amplifies returns. They don't borrow money to buy stocks, but if they did, they'd be better off. And all this to say, the best answer here is diversification. The housing market has done well at periods where the stock market's done poorly. Last few years, the stock market's done amazingly well, and the housing market's done poorly. So think of your home as part of your investment portfolio, but housing doesn't have to be your entire investment portfolio. That's probably my best conclusion. Diversification is always going to be a good answer. So maybe I'll leave that there, and Eric and Per, happy to open it up for questions.
That's awesome. Thank you, Christian. Yeah, so I guess one of the top things that people ask and people are thinking today, because if you look at how stocks are doing, and this is a picture of Canadian stocks, and the U.S. stocks, which is the real driver of your portfolio, has a very similar image, right? You've got your few different crises, but in general, stocks have done very well over the last 20 years. If I'm someone who's fortunate to have money to invest today, how do you recommend investing it? Obviously, your short answer is long-term equities, but I'm also concerned about, a lot of clients are concerned. I'm not concerned. A lot of clients are concerned about the market feeling toppish, feeling like we're at the top, right? And so, people get stressed about that. So how do you mitigate that? And Leah, let's just leave this chart up for a second, okay?
Yeah, it's a great question. So one thing I'll mention, like we're stats guys at RBC GAM. We spend a lot of time crunching numbers, and if you crunch the numbers, it'll tell you if you have money to invest, the best time to invest it was yesterday, and the second best time is today. But that's what the numbers say. But humans are have feelings and emotions, and the reality is you could get unlucky and invest right as the market is, as you say, like on the verge of a downturn, and then you'll just feel horrible about the whole experience. It'll prompt you to want to do things that are going to be detrimental, like selling when the market's declined, and ultimately have a bad experience. So one of the best strategies for mitigating that is what we call dollar cost averaging. Say you have $1,000 to invest in the market, but don't want to invest it all at one time. Just lumping it into, a little bit every month or a little bit every quarter to get into the market slowly is a good way to kind of spread your investment over a longer period. And then if the market does sell off, it gives you the option of, say you've put a quarter of your investment in so far, maybe the market sells off and you just put the rest in then and take advantage of volatility. So, dollar cost averaging, which basically is just putting your money in gradually, is a good way to ensure that A, you're getting into the market, because you might just be waiting forever. If you wait for a sell-off, you could wait a decade and miss out on huge returns. So dollar cost averaging gets you into the market, but also gets you into the market at a way that, in a manner that's not gonna be reliant on timing. So that's my best strategy. It's natural to be worried. Basically, we go from two states. We go from markets performing really well and us being worried about it declining. And then when the markets do decline, we worry that it's never going to recover. So basically, we're just always worried the market's going down. So has it been an amazing run? Absolutely. It could be a continued amazing run. Like if you had told me it would be an amazing year in April when all this tariff stuff was popping off, I would have been surprised to hear that, but that just speaks to how difficult it is to forecast. We could be in an excellent position 12 months from now. So yeah, I think just dollar cost averaging is going to be your friend in an environment like this.
Yeah,
I've got a bunch
well
more
said.
questions, but Erik, you got one, I think.
Yeah, we'll go ping pong style. Christian, I presume in your role, and thanks for, I mean, this really gives a macro overview of a lot of different levers. So I hope that was helpful for everybody on the call and just to delve in on how this all works and how this affects markets and portfolios. So thank you for that, Christian, and Joseph as well. Question for you, Christian. I presume in your role, I mean, you speak with PMs, portfolio managers from different equity teams, fixed income. Can you maybe shed some light on what's potentially keeping them up at night these days, and maybe share in the opposite, what's any cause for optimism? If you can share your thoughts on that.
Yeah, it's a good question. So maybe I'll answer from like an economic perspective and from like a company specific perspective. Like from the economy in Canada, like the trade deal is the biggest overhang at the moment. I think there's a lot of worry about what it looks like, or if we get to a deal, or what. Like that's going to be what really impacts all areas of the Canadian stock market. So I think that's largely the fact that it's unpredictable is what keeps a lot of portfolio managers up at night.
Sure.
From a stock perspective in Canada, I haven't talked about gold in this presentation, but gold has been an enormous driver of returns in Canada because it's not a huge part of the market, but it's growing. It's now about 16% of the stock market is gold companies. And what's tough for our portfolio managers is a lot of these companies, is some of them, the larger ones, are very well established. They're in jurisdictions that are free from too much risk. Like they're in, they're based in North America, but some of the smaller ones, we don't know really what their asset quality is. They're located in jurisdictions that have a lot of permitting issues. They maybe have troubling relationships with their local communities, stretch balance sheets. Like they're difficult. Um, they're just like difficult as investments. So I think managing that exposure in Canadian equity portfolios has been a challenge. And then I think just general, AI is one. Like there's so much talk about like, is AI a bubble? Is should we be concerned about uh, too much euphoria around artificial intelligence? And what I'll say is from the biggest companies, we don't feel like that's the case. There's still like we would worry when Nvidia says they have inventory of chips, and right now they're still telling us they can sell them faster than they can make them. So we're not at that point yet, but there are still some companies like, there's companies that add AI to their company name, even though they have no revenue, and then suddenly investors start flocking to them. Like that's the kind of behavior that that worries us a bit. So I'd say those are the kind of the big themes that, at least on the equity side, that portfolio managers worry about. On fixed income, it's yeah, that's not my area of specialty, but the really the concerns are twofold. Like one, companies start defaulting, which hasn't been the case, and the market's not very worried about defaults. But if that were to transpire, that would be bad for fixed income investments that have credit risk, basically bonds that are issued by companies. And then B, interest rates. If interest rates rise, typically bond values decline. That's what took place in 2022. And interest rates are unlikely to rise unless we have problems with inflation again. But given the stickiness in the US, there are still some lingering concerns. So that's a long way of saying there's always things we're worrying about, but there's some pretty serious offsetting positive factors at the moment. So pretty balanced, I'd say, is our overall outlook.
Thank you.
That's great. Very specific. Let's see if that covered. Eric, you stole my question.
Very fair.
One of our clients was asking about Canadian mining stocks. So this is very specific. In light of Ontario's push to develop the quote unquote ring of fire, any thoughts on Canadian mining stocks other than gold good and gold go up?
Yeah, it's funny. I've been asked about the Ring of Fire in almost every presentation recently. It's so the Ring of Fire, this area in Ontario that is suspected to be very mineral rich, could be really good for, in particular, the province, as well as the companies that would develop it. But there still are some pretty major obstacles, like for instance, like making roads and just like establishing a presence in that area is going to take some time, as well as permitting, which can take years. So I think it's super positive, but I think it's likely going to be a longer term uh, positive than shorter term, just given the kind of multitude of things to work through before anyone's actually getting assets out of the ground there. Mining stocks in general, they can be tough as investments. There's kind of a reputation from mining stocks or mining companies for being undisciplined, making acquisitions that don't make sense, spending too much on growth, and ultimately getting themselves into trouble when they're making tons of money. Like right now, like gold companies, they're earning like $2,000 now. Like their margins are incredible. But the worry is, mineral price declines while their costs are increasing and suddenly the margins are gone. So we're very, very carefully watching not only some of the individual risks, like Barrick Gold, for instance, is going through all sorts of issues with their Pakistan copper mine and their mine in Mali, which has like people arrested, and just like there's lots of individual company risk. But then, in general, we're looking for the sector to be more disciplined with spending than they've been in prior cycles. So that's kind of our view on mining.
Thank you.
Christian, I've got one. We looked a little bit at equity valuations. If we can double click on that, maybe can we talk about where you are seeing or where your team is seeing valuations and maybe a little bit about geographical allocations? So maybe kind of where those are now, Canada, US, international, and maybe what you're seeing flow-wise and any insights that you derive from that.
For sure. Yeah. Just a moment. I'm just going to plug in my headset because it's got battery low message, but it's a great question. Valuations, basically the highlight is in the US, quite lofty, as there's a lot of kind of elevated expectations about the future of US equities. Just
I'll let you know if the volume cuts out as well.
sorry, can you still hear me? Okay.
Yep.
I thought I lost you.
Nope, all back.
in U.S. equities, the benefit or the valuation is lofty as there's an expectation that U.S. companies are going to make gobs of money from AI as they have been so far. So far the valuation's been justified. In Canada, the valuation we'd say is pretty fair. It's not super cheap. It's not super expensive. It's right around where it's been over the long term. And considering that there's more tech companies than there've been in the past, we think the valuation is probably pretty balanced. But most of the flows this year have gone into Europe and international equities because in Europe the price for stocks is quite cheap, and a lot of that is because of concerns that have been had around geopolitical risks, around Brexit, and just around just general profitability of European companies. But that's changing a little bit. Germany and France have talked about big, fiscal spending programs, which should have positive implications for companies in those countries. And Japan is also part of that a big part of that international index. And Japanese companies haven't been very focused on profitability for a long time, but that sentiment seems to have shifted. So um, there's some positive things coming out of global equities outside of North America, and the price is quite cheap. So that's caught a lot of investors' attention. So there's good reasons to be in all three markets, but from a valuation perspective, the price of stocks outside of North America is definitely more compelling. Looking just straight up price.
Fair, did you have one more?
Yeah, what do you think? I'm getting lots of thank yous here as we start to hit towards 1 o'clock. So thank you, Chris.
Great sign.
Joseph. But what do you think the impact of having a minority government in Canada? I know Carney seems to have been able to string it along here, but at some point, I'm assuming the other parties will get annoyed and his, because he has a slight minority. Any impact do you think on the Canadian markets or thoughts on there?
Yeah. It's interesting. Like we've run the math on different like minority government, a minority government led by liberals, minority led by conservatives, majority liberal, majority conservative, et cetera, throughout history, and looked at the stock market performance. And the first conclusion you make is that it doesn't really matter who's in power or what the setup looks like. The stock market performance is about the same, which maybe calls into question, maybe we overstate the importance of the government, or maybe it's just a lot of policy just takes many years to materialize. But yeah, I guess the short answer is it doesn't seem to matter too much to the market. But one interesting thing is uh, looking globally, the market tends to do better in minority government setups than majorities, which again is maybe a bit counterintuitive. Perhaps it suggests that the market just likes it when the government can't get anything done. Uh, but yeah, so from a stock market perspective, a minority government, like the data suggests, should even be more positive. But I think in this instance, because there's some specific challenges that Carney needs to address, in particular, Canadian competitiveness, diversifying our trading partners. Obviously, this year has highlighted we've been way too reliant on U.S. trade over the years, and now it's been a great horse to hitch your wagon to from an economic growth perspective. But it's time now to diversify. It's time to support Canadian businesses, work on competitiveness. I think those are the main. Those are going to be big priorities, and I can't imagine he'll face too much opposition on those. But it's a good
Yeah,
question. I think
that's really interesting, and I feel like I like my politicians like a 1950s child. They should be seen but not heard, right? Just stay in the background and do your job. Right. So if you could just leave us with, I think we're almost out of time here, Erik and Christian and Joseph. But if you leave us with two sound bites. So number one, what's your number one stress thing that keeps you up at night in like 6 words or less? And what's your number one thing that makes you irrationally exuberant and super excited about the markets in 6 words or less?
what keeps me up at night is optimism shifting to pessimism. Suddenly investors decide the market's not worth 23 times earnings, it's worth 18 times. It's hard to forecast that. That's what definitely worries me. What makes me excited is artificial intelligence. Frankly, I think it's going to be big. It's going to impact many companies, and it's going to be a meaningful driver.
Awesome. Throw it back to you.
Wonderful. Well, Christian, big thank you for sharing this out. I mean, it feels like it's flown by and we've covered a ton. So really, thank you for spending it with us. Hopefully, you've got a nice lunch waiting for you after. To everybody who's attended today, hopefully you enjoyed this. We certainly did. We thank you for tuning in. If you did register, you will get a copy of the recording at some point, so you can rewatch this and listen if you wanted to. Delve into the insights again. But on behalf of Pierre, myself, Jeff, Leah, the entire WWH team, wanted to thank the RBC GAM partners that we work with very well. Thank you for sharing this today. Thanks, everybody. Have a great rest of the day. Go Jays, and we will see you again soon.
Thanks, guys.
Thanks, everyone.